This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Here we're going to go through and look at how to consolidate an overseas subsidiary. Before we go through and consolidate, we need to go through there and ensure that everything is correct within that functional currency of the subsidiary. So if there are any overseas transactions within that subsidiary, we need to get those up to date first and work out any gains or losses. Then once everything's correct in that subsidiary, we can then begin to consolidate. But the issue that we have is that the functional currency of the subsidiary is different to the presentation currency of the group, isn't it? So what we need to go through and do is we need to come up with rules about how we're going to go through and translate that overseas subsidiary. What are we going to translate? Well, we're going to go through there and translate things in the statement of financial position. And we're also going to go through there and translate things before we put them in profit or loss and other comprehensive income. The rules, there aren't all that many of them. You know, if you look at the profit or loss and OCI, it's really simple. You translate everything, income and expense, at the average rate. Technically, you should go through and look at every individual income transaction, every individual expense transaction, and use the rate that was in place on that date. That would just be catastrophic for some of our huge listed multinational entities, wouldn't it? Because they have millions and millions, billions of transactions of income and expense every single year. So therefore, providing that the exchange rate doesn't fluctuate too significantly, which in most developed nations it wouldn't, then what would happen there is you just use the average rate. What is the average rate? It's whatever you see within the question. There is no specific information given within the standard about how to calculate that average rate. So you can make up anything you so wish. The statement of financial position is a little bit more comprehensive, is that here you translate all of the assets at the closing rate and all of the liabilities. Don't start thinking, right, what about the monetary assets and monetary liabilities and non-monetary assets and non-monetary liabilities that we spoke about with regards to the functional currency? No. Yeah, we need to translate everything, don't we, so that we can then consolidate it. So all the assets, all the liabilities. Okay. What about your workings? How do we go through and look at the workings to help us calculate some of the figures in the group accounts? Because remember, in the subsidiary, we don't see any goodwill. We don't see a non-controlling interest. You know, they are all part of the workings, aren't they, for the consolidation? So what we do is the net assets working is in the overseas currency. So you look at the net assets at the year end, the net assets at the reporting dates, at acquisition and post acquisition, don't we? So reporting date, at acquisition, post acquisition. Okay, still share capital, still retained earnings, still PUP adjustments, still fair value adjustments, but everything is done in the overseas currency, so the functional currency of the sub. The goodwill, again, is worked out in the overseas currency. Key bit there is the reason behind that is because goodwill represents the brand name, the customer loyalty of the subsidiary, and that customer loyalty, that brand name, the reputation is all based overseas. So it is therefore an overseas asset, isn't it? Once you've worked out the goodwill and the overseas currency, you need to go through there and translate it at the closing rate. Okay. Non-controlling interest, your NCI, again, that's what the non-controlling interest shareholders own of the overseas subsidiary. So therefore, we will go through that and work out what the non-controlling interest own in the overseas subsidiary, because they own the shares of the overseas subsidiary, which will be denominated in the foreign currency. So the fair value will be in the foreign currency. The post-acquisition profits will be in the foreign currency. But once we've calculated it, we then need to go through there, don't we, and translate it at the closing rate. Okay. So everything you see so far in the SFP is at the closing rate. It will never, ever change. Okay. Last one, just a little bit of an aside, really, but still important. the group retained earnings. Be careful with the group retained earnings, because that's looking at what the parent owns, isn't it? And the parent owns 100% of its retained earnings. So we're going to work the group retained earnings in the presentation currency of the group. The issue that you've got there is when you take 100% of P's post-acquisition, 100% of P's retained earnings, you then need to add on your share of S's post-acquisition profits. So what we do there is we take S's post-acquisition profit, so that will feed in, won't it, from the net assets working, and you translate that at the closing rate and then take your share. And also as well, that there's a funky little bit here in that we need to go through there and translate the investment that we have in the subsidiary. And what we're going to go through and do is when we translate that investment, we will calculate the gain or loss on P's investment that we generate, and then we look at that gain or loss, and then we put that there into the group retained earnings. But we'll see more of that a little bit later. It's a bit of a cheat, it's a bit of a shortcut, but it will work for any question that you get within the exam. Okay, so that's how you translate the SFP. That's how you translate profit or loss on OCI. There's not a lot to it, is there? The rules aren't massive. SFP, everything at the closing rate. Profit or loss and OCI, everything at the average rate. Anything then in the workings to do with the sub is calculating the overseas currency and translated at the closing rate. That's it. That's all that you need to remember. The key bit, I suppose, is the application, which is what follows within the question and which is what follows within the next video. So just check that you're happy with what we've covered there before you then go through and have a look at the next question together. So hopefully you're happy with the rules of overseas consolidation that we covered previously. Now what we're going to go through and do is just work a big comprehensive example together. Okay, you're not going to get a question in as maybe much detail as this, but any part of the question in terms of the requirement could be one objective test question. Admittedly, the information will be much more condensed and much easier to digest. Okay, so if we look there, what we can see is we have, is it the statement of profit or loss? The two companies, is it Holly and Ivy? And you can see there that Ivy is there quoted in dinars, so millions of dinars, whereby Holly is in millions of dollars. If we go through and look at over the page, we can see the position statement, can't we? So when we look there at the position statement, we can see the two companies, Holly and Ivy. And again, Ivy is denominated in millions of dinars. Okay. Again, what you can see there is you have an investment in Ivy that there is at $200 million. So my assumption would be that Holly is the parent, maybe Ivy is the subsidiary. You've got plenty of information there with regard to the additional information. So in part one, it tells you a little bit about the situation with regards to the parent and sub. So Holly acquired 80% of Ivy. So Holly's there the parent, Ivy is the sub. Gives us a bit more information about what we'll use to feed into our net assets working. NCI is based on your proportionate share of net assets, so your partial goodwill method, and then you have the exchange rates. The exchange rates there are 1st of January, 31st of December, and the average rate, which I suppose we'd use for the statement of profit or loss. Figures that we want, it doesn't ask us for the full consolidation, but it wants us to work out goodwill, which will be there for the 31st of December 20x5. So is the 31st of December rate, that's my closing rate, isn't it? So the goodwill, I'll work out in the overseas currency and go through there and translate it at the closing rate. You also have there, is it your non-controlling interest? So I will need a non-controlling interest working, okay, to go through there and incorporate into Holly. So again, we'll need to work out in the overseas currency. You also need, is it your group retained earnings? So the key bit there about your group retained earnings is that we work it in the presentation currency of the group, don't we? We might need to do something with S's figures. And then you've got a little bit there to do with, is it property, plant and equipment and inventory. So the actual consolidation of adding across 100% of P, 100% of S. Just be careful with property, plant and equipment. Is there any fair value adjustment? And for inventory, is there any PUP adjustment? I do think on the video there it says Bill. We'll ensure that that is changed so that it says Holly when you have the full notes to download. Okay, it's just an updated question. Okay, so we are focusing on Holly. For Bill, read Holly. Okay, the key bit that you've got, I suppose, for the first two calculations, the Goodwill and the NCI, is that you need a net assets working, don't we? So what I'm going to go through and do there is I'm going to go through and set up a net assets working. Okay, so grab yourself a separate page of paper. We're going to go through there and work out the net assets. So on the net assets, I need year end. I need acquisition. And I also need post-acquisition, don't I? Okay. I'm going to go through there and take, is it my share capital and my retained earnings. So they are there, aren't they, from S's statement of financial position. Okay, so if I find S's statement of financial position at year end, you've got 350 and is it 280. So I can put those in 350 and is it 280. Again, like we've seen previously, the 350 at year end is then the same figure as what we have at acquisition, isn't it? And then we need to work out what the retained earnings are. So usually the additional information reveals that. So 1st of January, we bought 80% of the share capital for a consideration of 760 million dinars. The retained earnings were 150 million. And the fair value of the net assets was 600 million. Any difference between the fair value and their book is due to non-depreciable land. So a little bit tricky there, because what we've got, we're given the retained earnings. Is it there of 150? And we're told that the fair value is 600, isn't it? Okay. 350 plus 150 is 500. That does not equal 600. So there is a balancing figure. That balancing figure is 100. And that is your fair value adjustment, isn't it? We're not told of it changing up or down. So that stays there. Is it as 100? And if you total up, is it there? 5, 630, 730. Okay. Giving me their post-acquisition profits of 130. Okay. The post-acquisition profits are going to go into your non-controlling interest working. They're going to go into your group retained earnings working, whilst the net assets at acquisition are going to go into your goodwill working. So the net assets working of the sub is done in the overseas currency, isn't it? We've done that because we need to calculate goodwill and non-controlling interest. So goodwill is done in the overseas currency, isn't it? Based upon the dinars. So we've got there, is it your cost? Remember, we are working in millions of dinars. So what you have there, be careful not to take that 200 figure, because that's $200 million. Okay, we want the dinar figure. Now here we're actually given it, which is a bit of a bonus, because it's there at 760 million. We don't necessarily have to be given it. You could actually work it out. If you've got a rate at the 1st of January of 3.8, it's dinars to the dollar So if you do, is it 760 million dinars divided by 3.8, that should give you $200 million. So, you could work it backwards by taking the 200 multiplied by the 3.8 to give you 760 million dinars. But all we're showing there is that they have recorded the investment correctly. Okay. We need to put in the 760. So we can put in there, is it 760 million dinars. We add on, is it the NCI share of the net assets at acquisition. So the non-controlling interest is based on the proportionate share. So is that 120? And then we deduct the net assets in full, which is 600, isn't it? Okay, that 600, if you're curious, comes from there. Okay, your net assets working. Totaling that up, 760, 860, 880 less 260, less 600, is that 280. So that's my goodwill. Be careful. That's in dinars, isn't it? So we need to translate that there at the closing rate. Okay. The closing rate, what have we got? Let's just go back and check. The closing rate that you have is 4.3, isn't it? So if we go through there and do, is it 280? We're converting dinars to dollars, so we are going to divide. So 280 divided by 4.3. Check my arithmetic. I think that is there. Is it as $65.1 million? Okay. Quick check. 280 divided by 4.3. 65.1. Okay. So yeah, there's your answer, and that's the number that you would put within the box. $65.1 million. Your non-controlling interest, your NCI. Remember, that takes the non-controlling interest at the date of acquisition, which we know is there as 120. So again, we work it in the overseas currency. We add on 20%, so the non-controlling interest share of the post-acquisition profits. And those post-acquisition profits are 130. 20% of 130 is that 26, which gives me NCI of 146. Okay, 146. Again, if I go through there and do the 146 divided by the 4.3, does that give me there? Is that 30? Let me just check. 4.3, 146 divided by 4.3, is that 34? Okay, if you round it, you end up, is it there with the 34? Okay, 33.95348837. Okay, which is there as 34. Okay, excellent. We then go through there and look at, is it the group retained earnings? Remember, now we work this in the presentation currency of the group. So that's there in your millions of dollars. Okay. So here we put in, is it 100% of P's retained earnings? So 100% of P's retained earnings is there, isn't it? 110. Okay. So if I put in 110 within there, I then need to go through there, don't I, and add on, is it 80% of the post-acquisition profits of the sub? But just be careful, because that 130 is in dinars, isn't it? What we need to do there is we need to divide it by, was it the 4.3? Because that 4.3 is the closing rate. Remember, everything to do with the sub goes in at the closing rate. And that gives me, there is that 24.2. Okay, there we go. Okay, so you've got the post-acquisition profits, we're there as 130. You have then got to translate that at the closing rate, and the closing rate, if memory serves me right, which I'm pretty sure it was, oh, too far, it's floating there, isn't it? You can see it's moving up and down, but you've got it there, is it at the 4.3? Okay. The difficult bit that you've then got to go through and do is there could then be, is there an exchange difference on P's investment? Because what we've done essentially is that investment, was it at $760 million? What we've gone through, sorry, 760 million dinar. What we've done is initially it was the 760 million dinar at 3.8, wasn't it? So that was initially recorded at 200 million, wasn't it? But that 200 million we need to eliminate on consolidation, don't we? So when we eliminated it on consolidation initially at the acquisition date, the rate that we used to translate the investment would have been exactly the same rate that we used to translate all of the assets and all of the liabilities for our very first consolidation, okay, at that point when we bought the subsidiary, okay. However, the exchange rate has moved, so we've used the closing rate to revalue all the assets and liabilities into the presentation currency. But when we eliminate it against that investment, it's eliminated against an investment at the old rate, don't we? So what we need to do is we need to work out the exchange difference on that investment, okay? If you do 760 divided by 4.3, does that give me the $176 million? Okay, remember this is the value of the investment, so this is what it was, this is now what it should be, so that when we eliminate it against all the assets and liabilities at the closing rate, that it cancels out. So what you have there is that a reduction, or should we say 177? 177 sounds about right, doesn't it? Just check again. 760 divided by 4.3, 176.7. Yeah, 177. Okay. 200 less than 177 is that $23 million. That 27 or $23 million is a reduction in an asset. If you have a reduction in your asset, then that gives rise to a loss. Okay, a loss of $23 million. That loss of $23 million goes into your group retained earnings before we go through there and look at any other bits and pieces. Okay, we need to be careful. I think, if memory serves me right, there is a PUP adjustment, isn't there, within this question? Let's just check. What's that? No, I removed the PUP adjustment. Okay, so there's no PUP adjustments. Excellent. Sometimes I can never remember what I've done previously. Does that give me, is it 111.2 million dollars, isn't it? Okay, so I would always do a separate working for the exchange gains and losses. I think that's quite a challenge, isn't it? Make sure that you translate the post-acquisition profit of the sub at the closing rate. Okay, so do just be careful there. And again, that working, standard working, look at what the investment was initially recorded at compared to what it is at now. Okay, if it's a reduction in asset, it's a loss. If it's an increase, it's a gain. Okay, just to finish it off, I think we've got there, is it your property, plant and equipment and inventory. So PPE, what you've got there is we need to consolidate, is it 100% of the parent plus 100% of the subsidiary. But again, that's where you need to be careful, isn't it? Because when you go through and look at that subsidiary, I put in the 500, haven't I? Put that 500 is in dinars. So it needs to be translated at what? The closing rate. Okay. The closing rate is 4.3. Don't forget though, and this is where it can get challenging, you also have a fair value adjustment of 100. That 100 needs to be incorporated at the closing rate because it is in there at dinars. Okay, so in total there's 600 in the sub that's translated at the 4.3. Add on the 200, I think that gives me 339.5 million dollars. Okay, there we go. Excellent. Not too bad. The key bit is, remember, not to forget the fair value adjustment, and when you put these values in of the sub, yep, it's in there, isn't it, based on the closing rate. The inventory, I think I must have taken pity on you whilst writing the question, because on the inventory there is no provision for unrealized profit. Okay, should we just say it's there's the current assets? So what you've got there is the current assets. We can add across, can't we? So 100% of the parent, the subsidiary, and the subsidiary is there, isn't it? At the 4.3. At 4.3 is the closing rate. So that 90.7 plus 90 gives you 180.7 million dollars. Okay, I think what I'll do is before we publish the notes, etc., I will change that word inventory so that it says current assets. Okay, just so to see that you add things across 100% on a line by line basis, and that you translate everything to do with the subsidiary, don't we, at the closing rate. I think maybe I put in an example there that's probably a bit too hard and possibly scare you. Just look at each bit in isolation. Okay, look at the goodwill separately. Can you do that? Can you do the non-controlling interest separately? Can you do the group retained earnings? I think that's probably the hardest one to think about. Okay, don't worry so much about doing the full consolidation. If you're crazy enough, you could, and you would see hopefully that it balances. Other than that, that's it for the time being on the group accounts. We just need to look after in the next session at some gains and losses on translation of the subsidiary